Everyone wants to get rich investing, but in 2025, most people are doing the exact things that quietly destroy their wealth. Not because they don't try hard enough, but because they don't know what's actually holding them back. In a year full of opportunity, these 5 mistakes can cost you the very future you're trying to build. Welcome to Invest Education Hub, where we turn smart investing into simple decisions. Stay with us until the end. This might be the most important financial reality check you'll hear all year.
So, let's just dive right into it. For decades, investors have been arguing over these 2 legendary paths to building a fortune. And let's be honest, saying you're a real estate investor just sounds a little cooler, right? It brings to mind these big personalities and flipping shows on TV. Index funds, on the other hand, can sound, well, kind of boring. But you absolutely should not let that fool you. Both of these have created incredible wealth. And today, we're going to give you a clear framework to decide which one truly fits your financial future.
All right, so to make this super clear, here's how we're going to break it all down. We're going to start with the big picture, then we'll do a deep dive into each investment type, we'll put them head to head, and then we'll wrap it all up with an actionable strategy that you can actually use.
Okay, so first things first, we got to understand the world we're investing in right now. Because 2025 is not 2020. You've got higher interest rates, right? That means getting a mortgage for that rental property is going to cost you more than it did a few years back. Inflation has definitely cooled off, thank goodness, but it's still there, kind of nibbling away at your savings. Meanwhile, the housing market has pumped the brakes on its crazy pace, while the stock market is riding these huge waves of innovation and things like AI, so both markets are interesting, but for totally different reasons.
Okay, let's dive into our first path, index funds. Now, a lot of experts call this the simplest, most effective way for the average person to build some serious wealth. You're basically putting your financial growth on autopilot.
So what in the world is an index fund? Really? Well, in a nutshell, it's like instead of trying to find that one magic needle in a giant haystack, you just buy the whole haystack. For instance, an S&P 500 index fund lets you own a tiny piece of the 500 biggest, most successful companies in America. We're talking Apple, Microsoft, Amazon, all of them, all bundled together in one simple investment.
And look, the numbers here really do speak for themselves. Over the long haul, the US stock market has returned over 10% a year on average. Now, to put that into perspective for you, if you had invested just $10,000 back in 1995 and just left it alone, you'd have something like $210,000 today. That is the incredible power of compounding. It's this hidden engine where your money starts making its own money. It's kind of slow at first, but over a few decades, it becomes this unstoppable force.
Now, what's so amazing here is you're getting sheer convenience and power all wrapped up in one. You get instant diversification across hundreds of companies, which seriously lowers your risk. The costs are insanely low. We're talking maybe $40 a year on a $100,000 investment. And maybe the best part, and you gotta love this, no tenants, no toilets. It is truly passive. You can set it, forget it, and just let it do its thing.
Okay, but it's not all sunshine and roses. There are definitely downsides. With an index fund, you're basically along for the ride. When the market drops 20%, guess what? Your portfolio drops 20%. You can't avoid it. You're also guaranteed to only get the average market return. You're never going to beat the market this way. And you know, maybe the biggest risk here isn't even the fund itself. It's our own brains. It is so tempting to just panic and sell everything when the market is crashing, which locks in your losses at the absolute worst time.
All right, now let's switch gears and talk about path number 2, real estate. This has a completely different vibe, right? It's an asset you can actually see, you can touch it, you can improve it, it can spit out cash every single month. And for a lot of people, there's just this deep emotional satisfaction that comes from owning a physical piece of property.
Okay, before we get any deeper into real estate, we have to talk about its secret weapon. It's a little word called leverage. This is the supercharger. It's how you can take, say, $100,000 of your own money, borrow $400,000 from the bank, and now you control a $500,000 asset. Now, if that property goes up in value by just 5%, that's a $25,000 gain. On your initial $100,000, that's a 25% return. That is the power of leverage, and it's what can make real estate returns so explosive.
And this is where real estate really starts to shine, because you get paid in multiple ways from one single asset. First, there's cash flow. That's the rent you collect after you've paid the mortgage and all the other bills. Second, the property itself goes up in value over time. That's appreciation. And third, and this is a big one, your tenant is actually paying off your loan for you every single month. That debt paydown builds your ownership stake, your equity, without you doing anything. I mean, how cool is that?
And the pros here are really strong. It's a physical asset and it tends to hold its value really well when inflation is high. The tax benefits are huge. You can deduct things like mortgage interest and property taxes. And unlike stocks, you have control. You can put in what they call sweat equity, renovate a kitchen, finish a basement, and directly force the value of your investment to go up.
But, and this is a big but, anyone who tells you that being a landlord is passive income might be stretching the truth just a little bit. The reality is, it's a part-time job. It takes real work, real time, and it can be a real hassle.
And yeah, the downsides are very real. This is where people get into trouble. You need a big pile of cash just to get in the game. Your money is also very illiquid. You can't just click a button and sell your house in 5 seconds. It can take months. And your risk is super concentrated. If you own one rental property, your entire investment is riding on that one house in that one neighborhood. And finally, yeah, it needs to be managed, either by you or by a property manager that's going to take a cut of your profits.
Okay, so we've explored both sides. We've seen the good, the bad, the ugly. Now it's time for the main event, the head-to-head showdown. We're going to focus on the data here, not the drama.
So, this is the big one, right? The question everybody wants the answer to. Which one is better? But the truth is, and you might not like this answer, there is no single right answer. The better investment depends completely on you, on your goals, your personality, and how much work you're actually willing to put in. Now, this chart just lays it out so perfectly. It really shows you the fundamental trade-offs. With index funds, you get amazing liquidity and diversification for almost zero effort, but what do you give up? Control and tax benefits. With real estate, it's the exact opposite. You get a ton of control and incredible tax advantages, but you lose liquidity, you lose diversification, and you have to put in way more work and cash up front. You see the pattern here, right? It's a complete flip-flop. So when you boil it all down, it comes to this. Each strategy has its own unique superpower that drives its growth. For index funds, it's the slow, quiet, but unbelievably powerful magic of compounding over decades. That's the hidden engine. For real estate, it's the immediate, powerful force of leverage, the supercharger. And figuring out which of those two engines you're more comfortable behind is really the key to this whole decision. Okay, so with all of that on the table, what do you actually do? How do you build a strategy that works for you right now in 2025? It's not about picking a winner, it's about building a smart plan. For a lot of people, the answer isn't either or. It's about finding a middle ground, and that's where something called a REIT comes in. That stands for Real Estate Investment Trust. Basically, it's a company that owns and operates a whole portfolio of properties. Think apartment buildings, shopping malls, data centers. And because they trade on the stock market just like a normal stock, you get the income potential of real estate, but with the liquidity and low cost of an index fund. It can be a great way to get the best of both worlds.
And this chart gives you a really good idea of what a balanced approach could look like. Now, obviously, this is just an example. Your numbers might be different. But a setup like this gives you that long-term growth from stocks, the income and inflation protection from real estate, some stability from bonds to soften the blows, and then cash on the side for emergencies or opportunities. You're not putting all your eggs in one basket.
But you know what? We can talk about numbers all day long, but the biggest factor is often something else entirely. It's psychology. It's how these investments make you feel. Real estate feels solid, it feels secure, because you can drive by and touch it. Stocks can feel really abstract and kind of scary. They're just numbers on a screen. And that matters, because the very thing that's a downside for real estate, its illiquidity, often protects owners from themselves. It stops them from panic selling in a downturn, which is a huge mistake that destroys wealth for so many stock market investors.
And that really brings us to the single most important point of this whole discussion. The real secret to building wealth isn't about finding some perfect asset that never goes down. It's about finding a strategy that you actually understand, that you believe in, and that you can stick with for the long haul, even when things get choppy and really uncomfortable. Consistency is what separates the successful investors from everybody else.
Building wealth isn't about being perfect. It's about avoiding the traps that keep most investors stuck. If you can eliminate these 5 mistakes, you're already ahead of 90% of people trying to grow their money in 2025. Start consistent, stay disciplined, and let time and diversification work in your favor. If this video helped you see your financial habits in a new light, like it, subscribe, and share it with someone who needs to hear this message. Here at Invest Education Hub, we turn financial complexity into clarity, one smart decision at a time.